This might kind of annoy my existing investors a little bit, but I think we need more founders that are very opinionated and less malleable to the investors' feedback because they want to fundraise. I feel like investors in the top of the value chain of where dollars gets injected in the startup ecosystem determine what companies are going to be built versus the market at the bottom of it, and then the founders that are building for it determine what companies need to be built, which I think is part of why the hit rate in the VC market and in the VC kind of business model is so low. In my view, you get one shot at this or a few shots in your whole career to launch these types of companies. Do what you think is gonna move the market towards a more efficient, more accessible ecosystem, whatever market you're playing in, and let capital follow that. Do not follow capital. And that's a danger that I think is even orders of magnitude more dangerous in hype markets.
Welcome to Inside the Round, where you get to learn about capital raising from founders who have just done it. I'm Helena Fogarty. I'm a fundraising expert who helps startups raise their seed and Series A rounds. And today I'm speaking with Nima Roohi of Blooming Health. Blooming Health is a health tech company with a mission to make sure people get connected to the support and care they actually need, whether that's help with food, housing, transportation, or medical follow-ups. They've connected over 6 million people across 27 states to essential services. What makes their story really compelling is their fundraising journey. It was super hard for them to find investors at first, but they never gave up. Blooming Health has raised over $30 million in total, including a recent $26 million Series A round led by Insight Partners with investors including F4 Capital, Crossbeam Venture Partners, Metrodora Ventures, and of course their first believers, Forum Ventures. So let's figure out how they went from struggling at first to find investors to closing one of the largest Series A rounds in social care tech. I'm so happy to have you here.
I appreciate it. Thank you so much for having me. Excited to dive in and share a little bit of our story so far.
It's incredible. Like, we first heard about you when I was interviewing Jeff Becker, and he took us through a little bit of how hard it was for you to raise money. So I want to hear about that, but I'd like to take it back a little bit further to why you started a company and if you always knew you were going to be an entrepreneur.
Yeah, thanks a lot for having me. I appreciate the opportunity to be here today. I guess just not to answer this in a kind of cliche way, I've had my own journey between kind of pursuing science and entrepreneurship. I did PhD in computational mechanics at University of Wisconsin-Madison, which is typically a path if you take it, you're ending up becoming a scientist at a research institute or teaching at the university. But I think I actually had the entrepreneurship bug in me since childhood. I actually made the first kind of income when I was a kid, working for my dad as an accountant. So he was a accountant, financial advisor, and worked in banking. And this is like 25 years ago when kind of accounting software wasn't even taking off en masse yet. So a lot of accounting was happening in pens and papers, and the maximum kind of sophistication was Excel sheets and tables. And I was just entering numbers and kind of understanding what does kind of a balance sheet mean, et cetera. And this is like when I'm in kind of secondary school, and like in general, kind of grasping financials is probably a little harder to understand. But from then I understood that I want to build stuff that moves kind of the needle in the bigger economy for consumers, for population. And that bug stayed with me until I graduated from university in 2013. And I remember when I was graduating with PhD, my research advisor at the university was trying to convince me to go for an academic job, and telling him that, look, I love academia, and then you guys are doing an amazing job kind of educating folks like me, but I know I'm going to get bored. So I basically interviewed for a couple of jobs and then came to New York City from Madison to work for a construction tech company, basically building some products and solutions in the road construction industry, which would be an interesting thing to discuss how I found my way into the healthcare. Yeah. But even then, I was very excited about building products, but I knew I wanted to build stuff from ground up. I knew I wanted to kind of create something out of nothing. And I started kind of thinking about whether I want to go to an MBA and just kind of change my persona from this person with a PhD in scientific background into someone that actually has some business chops, and people would respect that. So they would listen to me and help me kind of become a product manager or a kind of a startup founder, et cetera. But then I learned this from a mentor I had at the time, who was a Harvard Business School graduate, told me, I think you would benefit a lot more in running a small P&L on a small product, a small P&L and a small product, than going to MBA. And I spent the next 1 to 2 years doing that and just plowing through business books. I think I read around like 100 books in like 2 years, and just understanding how sales works, marketing works, kind of product management, life cycle, et cetera. And then from there, I guess my kind of entrepreneurship persona kind of started sprouting and blooming, which resulted in founding a company.
That's very cool. It's just gotten very cold here in Europe. Not even that cold, but like compared to Madison,
Yeah.
what do you think? I've only been to Madison once, and there are people on the lake, driving out in the lake and ice fishing. That's amazing.
Yeah, so I actually love Madison. I still go there every year because I've got friends living there. I had a little bit of shock first year when I got an email from the university saying like, hey, if you're standing in a kind of bus station and the temperature is so low and your ears start dropping down, like you put them in your mouth and like go to the hospital immediately. And that like freaked me out. I was like, I've never experienced this much of kind of freezing temperature and cold kind of weather. But I want to remind everybody that Madison is home to a lot of amazing founders and kind of startup executives over the past few decades. Probably the most important one that a lot of folks in our industry, in healthcare, have heard of is Epic, and the electronic medical record database. But it was an amazing place for me to kind of start getting. I'm a first generation immigrant, by the way. So Madison to me is my home in US, and I really loved my experience out there.
Yeah, I've only been once, but it felt so dynamic.
Very dynamic.
And I was there in February, so it was.
All right, so you were not lucky. Yeah, absolutely. So I landed there in August for my first semester, so I had a few months to get used to the transition into the cold weather.
Yeah.
But I can't complain. I prefer a little colder weather than warmer weather, so I would prefer Wisconsin over Florida or Southern California.
Yeah, got it. Excellent.
Yeah.
So what led you specifically to focus on healthcare?
Yeah, it's funny. There's I mean, I wish it was a single event that I could point to, but there's a combination of different things that. The reason I wish, because it's a nicer story to tell, but like there's a combination of different things that happened to me that kind of brought me into the healthcare industry. It actually started, interestingly, with a conversation I had with a friend of mine from high school that was studying economics, I think, at Northwestern University in Chicago. He was a friend of mine from high school. A few years, I think, after I did my PhD, probably 2 years after that, we were having a conversation. I was asking him. He at the time actually was on a kind of leave from his first job at a hedge fund in Chicago. I asked him, like, if you had capital, what industry would you invest in? Like, where would you place bets on? And he explained to me a little bit the healthcare economy in this country, which for folks that might not be kind of building businesses in it and just their consumers, they might just see the inefficiencies, but they might not see how big those inefficiencies are, like economically and financially. I mean, most people hear that, hey, this is an industry that is like 18 to 20% of our GDP in the US. But I would say that I think it is important to benchmark that against like 10 to 12% in most of other industrialized world. And then being 6, 7, 8% more inefficient in the US, like relative to US GDP, is a huge number. So I was like, the first time I was like, all right, if I come from a background in technology and I want to bring automation, and this is like pre-OpenAI kind of explosion of AI and ML. but I did my graduate school in those areas. Like if I were to build automation where machine learning in industries, healthcare is probably going to be one of those. While I was kind of working in this kind of industry just to learn it a little bit more, me and my friend created a book club, a two-person book club, and we started learning the industries, the healthcare industry. This is basically during Obama's administration, where Affordable Care Act helped a lot of new companies to be born in the healthcare space. Um, we try to learn that. We try to kind of understand how healthcare insurers work, how hospital systems work, how pharma companies work, like what's the money flow looking like in there. And if you haven't figured out, I'm a big reader, so I was reading like 20
It's
books
amazing.
like about like healthcare industry. While I was doing that, I was like, I want to get a job in this industry because I feel like for me to understand the ins and outs of it, I need to kind of work with different stakeholders. I need to even understand the culture of this industry if you want to kind of build technology for it. So I decided to get a job in the industry. I applied to a few roles. I'm in New York City. So you had a few kind of healthcare companies in New York City, and then you've got pharma in New Jersey. And then out of those, I got a job in Bayer Pharma in New Jersey. And there I started running a global kind of ML AI team on a few different components of pharma operation, from drug discovery all the way to kind of go to market for a few different types of medications. That was my first entry into the industry. But I guess the most pivotal moment for me to start a company in healthcare was when I experienced the pains firsthand and challenges firsthand as a caregiver, where a loved one was diagnosed with stage 4 cancer, and me and my wife were her first kind of caregivers, and we had to navigate healthcare for her. And I remind you, I'm a first-generation immigrant, so I haven't seen this at play for my grandparents with this ecosystem. And it kind of bugged me that it's so painful to kind of get your loved ones the care they needed, especially in this most vulnerable moments. And if you had a little bit of chops for business, you probably would immediately understand, like, how much are we spending in catastrophic outcomes because we don't have the infrastructure to take care of them in advance. And that was really kind of, I would say, the most important inflection point for me to move into this space.
Yeah, and we spoke about this when we did our pre-interview, our first conversation, where, my husband just went through a cancer journey like 2 years ago, and it was just, it's insane the inefficiencies that you see as a patient
Yep.
or an advocate or, a caregiver, right? It's frustrating, and it's incredible that you use that to kind of power your work in here. I think it's amazing.
100%. And then it just happened at the time that I was a part of a New York City meetup called AI in Healthcare, where I was kind of in this community of a couple of entrepreneurs, technologists, folks that already have started a company, folks that were interested to start companies, etc. And I started talking about this idea with a few folks, and then it kind of happened that my co-founders had a kind of mutual interest in it, and we started working at it. I can tell you a little bit more about that.
Yeah, please do, because that was my next question.
Yeah, so basically I met my two co-founders, Nama and Kavitha, there as a part of a meetup. I remember still, like, it was, I think, March of 2019. We're doing a hackathon in Dumbo in Brooklyn at the WeWork space there. And then, like, basically, as probably 10 of us that were helping 30, 40 developers and kind of engineers building their POCs and kind of product ideas as a part of this hackathon around healthcare that we were running as a part of the meetup group that I mentioned. And then on the side of it, we decided to go grab some beers in the afternoon. It was a long day. It was like, I think it was a 12 to 18 hours like hackathon. When we're drinking together, we started talking about what ideas we had in mind and, like, we were passionate about. It just happened that me, Kavitha, and Naman had this kind of unique life journeys and experiences where brought a lot more attention for us to the non-medical angles of healthcare space. So Naman at the time was running a consumer product department at WebMD. Kavitha was coming from cancer research background at NYU and then moved into kind of digital health go-to-market space and then working on a product called, I think, Nuna. The three of us had literally first generation immigrant caregiving experience that like it was a question mark in front of us, like, why do we need to take time off? If you have a member of your family to care for, like you need to take a day or two off every time you need to take them to healthcare. You need to make sure you navigate all the paperwork. You need to make sure when they come back home, they have everything they need.
Yeah, it's devastating. Like, it's not just the person who's sick
100%.
who's having their life affected. It's everyone around them. And, that has implications on people's jobs, that has implications if you're a business owner. Like, it's incredible.
It's very, very difficult and challenging to navigate. And look, I think there's a couple of different trends happening that makes it even more challenging. One of them is that we're living longer and we have less number of childs. And as a result, for every child, you have more number of people for every person, you have more number of people that person needs to give care for, which makes all these complexities more resource taking and challenging for them to navigate. And we decided to start working this idea. Basically, if I were to simplify the idea to the kind of a kernel of it, we thought that if a patient leaves a medical facility, they still need a bunch of different services and coordinations of care and post kind of if they're at hospital, like post discharge services they need. We thought that there's got to be ways to make that more efficient and a lot more kind of centralized, less fragmented, and more cost efficient. Just to give you a few metrics on like why does that idea matter? Like first of all, we're spending around $1 trillion every year on non-medical services related to healthcare. So in transportation and food and housing and benefits, et cetera. So it's a huge, huge economy in and of itself. The second thing is there's plenty of research, both in the industry and academia, showing like there's around 70 to 80% of the healthcare outcomes are driven by those elements of care, meaning that 80% of the healthcare cost is related whether a mom post-delivery has a right to go back for baby checkups or not.
Wow.
That's so important. It's like we're investing so much to make diagnostics better, insurance models better, healthcare facilities more accessible, et cetera, et cetera. We're not as much thinking like whether that person has a right to show up for that appointment, right?
Yeah.
And there's data showing 80% of the cost is driven by that. If it's simply that person can show up for their checkup, you're going to be able to detect the stuff with simple tools and processes that you're otherwise missing and resulting in more complex outcomes. The first phase of our kind of process was really we tried to learn the problem a little bit better. So the three of us were like, all right, this is an idea that resonates with us. Let's go and start kind of exploring the market a little bit more. And then I don't like the term market research, to be very honest. It's like an abused term by kind of consulting firms. But it's really kind of us going and talking to consumers. So basically, if you have a two-sided process or market or a three-sided process and market, just understanding those three nodes, like healthcare insurance, providers, and consumers or patients, what does their kind of life look like in navigating these services, paying for these services, providing the services? So we literally would buy bags of fruits and snacks and go around New York City where we live in like in the tri-state area, basically, and go into community-based organizations and talk to older adults, for instance, sit down for half a day and try to understand how do they go to their healthcare appointments. If they have diabetes, like how do they make sure they're eating healthy? Are they able to go and buy groceries? Can they cook, et cetera, et cetera? And then understanding on the other side, the likes of like Northwell Health, how they are providing services to people, how they're making sure when people go back home, they're getting the care they need, and so on and so forth. And a lot of that kind of created our thesis on what a potential technology solution could be to move the needle towards positive and solve the problems here.
Now, social determinants of health, are there like big budgets already allocated to this, but then these services aren't appropriately distributed? Like how does that work? Because that's what I've heard, but I don't really understand that.
Yeah. So if I were to kind of summarize the problems within the social determinants of health or health-related social needs, this term is also becoming politicized. So there's like multiple
Oh,
ways to present it as well. Interestingly.
yeah.
Um, I think there are two core problems around it, and I think kind of I'll answer your question with those two core problems. The first one is there's so much fragmentation in that space. So you as a patient, you have a variety of needs, and for each of those needs, you have a totally different stakeholder to deal with,
Hmm.
right? Imagine in the context of like as a consumer of a grocery store, imagine if you had to buy your vegetables in one place and meat in another place and grains in another place, and then for you to even figure out where those places are, you probably, if you have a grocery kind of a purchasing list, a buying list, you probably are going to miss out on some of them.
Mm.
More importantly, you're going to feel frustrated as they add up, and you're not going to probably stick with them and probably going to sacrifice some of them, right? So fragmentation is the first problem. The second problem is data. So we have so much infrastructure to collect medical data from patients. We have so much infrastructure to know what their lab results are, like blood sugar level is, cholesterol level is, what their weight is. We know their DNA, we know their kind of family heritage, we know what their diagnostics have been over the course of their life, etc. We just don't know if they have enough food on their table or not.
Hmm.
We don't know whether they're at the risk of being evicted from their home or not.
Right.
We don't know if they're able to drive or not, or have access to a car or not, right? That data doesn't exist. Now, why does that matter? It matters because the way you treat diabetes is first to diagnose that person has diabetes, then give them the medication. You don't just randomly tell everybody that, hey, we have diabetes medications. It's available to you. If you feel like you need it, take it, right? Like if it was like that, it would have been very inefficient investment, right? That's the problem that exists within the social drivers of health or health-related social needs, where from 1 million people that is served by this health system or this health plan, you don't know who has a risky profile around social needs. And because you don't know that, you're not really funneling services very efficiently to the right people at the right time, which means that at the end of the day, the return on investment is going to be a little shaky, right? To say the least. Now, going back now to your question, the answer is yes, there are budget lines allocated for social determinants of health. The problem is the sustainability of those budget lines depends on the ROI they create, the return on investment they create. Because keep in mind, every dollar a health system or a plan spends needs to be tied to some sort of bottom line outcome, right? Some of it is also tied to the top line outcome, meaning like a health system wants to see more patients so they can generate more revenue, et cetera. But if these stakeholders are taking any risk on the population, they need to be able to serve them when there is a need, preventing kind of catastrophic outcomes. Simple stuff. Like I'll give you an example just to give you the economics of it. A single time show up of a diabetic patient to emergency room could pay for a full year of meals being delivered to that diabetic patient.
It's wild.
Right?
Yeah.
So now if you know who that person is, imagine how many ER visits you're saving and what's going to be the bottom line implication of that. So those are the core problems that we try to kind of put technology at use to solve for.
Wow, that's amazing. I appreciate you breaking that down, because it's really hard to get your head around. I mean, clearly you are an expert in this, but even before you're an expert, you read a lot and you studied this quite a bit. So I appreciate you breaking it down more simply for people that are not experts.
Yeah, absolutely. Look, I would argue I'm not even an expert in this. It's just there's this term going around right now. I think is viral on X called like you just can't read 25 books. I think you might know what it relates to, but like you could actually learn even a complex industry like this by really immersing yourself into it and kind of understanding the intricacies. As a kind of entrepreneur, for me, really, the most important part was like, where are the inefficiencies? What are the causes of the causes to those inefficiencies and who cares about those inefficiencies, basically.
Yeah. So, what made you think that you could build a business that would be venture backable?
Yep. That's a great question. So this is probably this is going to be the most important part of our discussion. If founders are listening to this, this is where you create a company that nobody else paid attention to or even disagreed with, but eventually was proven wrong if you're successful. So I think what made us to think that there's a venture scale company to be built here was kind of a couple of different things. One was the simple math, basically, like just understanding the economies of this problem, understanding how big this can get, and by just moving a few dials within the ecosystem, like how much you can save, like in tens or hundreds of billions of dollars. As I mentioned, like it's $1 trillion kind of total spending here. The second part was like just looking at examples in other industries where fragmentation was reduced by technology, and goods and services have been more accessible as a result of that.
Mhm.
And then the third one was like it just happened that we had this unique insight. It didn't just happen. We had this unique insight because one of my co-founders actually volunteered for some community-based organizations, but we kind of took that very seriously, going after this on-the-ground service providers or community-based organizations that deliver meals to people on the ground or provide rights and provide housing, et cetera. Some of them are pretty large. Some of them are arms of like multi-10 or $100 billion companies like Uber Health, Lyft Health, or things provided by CVS and Walgreens in the communities, et cetera. But some of them are very small, and just understanding if we were to serve these people, we need data to understand their needs better.
Mhm.
And the way to get that data is really to tap into some level of trust they have with existing stakeholders they're consuming services from. And then understanding that a technology layer could 10x, 100x the capacity to collect that data. And then layering delivery of services on that data could create a kind of $10 billion cost saving for the stakeholders involved, right? So it's the building blocks start like what the need of the member is, who do they have relationships with or consume services from, how can technology play a role in that kind of relationship to scale it up, to make it more efficient, to make it more scalable, make it more accessible for multiple different segments of population. So that, for instance, if your mom needs a medical visit, she doesn't call you to take her to the medical visit. There's a very easy, low friction way for her to get a ride, show up to her home, pick her up, take her to the healthcare facility and back. And if you can make that happen, then now can you scale that up at the national level and partner with the largest health plans and health systems to basically generate that value at the scale? We had a kind of a thesis with evidence on the ground, albeit at very small scale, that this was possible.
Mhm.
And believe it or not, nobody bought it at the beginning, but then we were able to convince them otherwise.
Yeah, that's why I actually changed my question. It's normally like, why would you think this would be venture scale? But I was saying, what venture backable? Because it's hard to communicate this
For sure.
to investors.
Yeah. Yeah, it is very hard, actually. So I had my own long journey with investors as a kind of a startup CEO where it's so funny. I'm going to just tell you a story that's probably be a little fun and people might see it and catch it. But the first ever pitch I've done, believe it or not, was to Founders Fund. So I wasn't even strategic in picking who I'm pitching first.
Yeah.
Right? I picked up some of the biggest funds and I went and pitched them. And I messed it up. I messed communicating what problem we're solving. I messed up like what the market opportunity there is out there. I messed up telling about our traction and what we have been doing so far, et cetera. I probably messed up the whole thing, right? And it's actually Delian from Founders Fund that took that pitch. So if he ever watches this, I want to apologize for wasting his time, basically, a few years ago. But I learned quite a bit from that. I understood what's the again, going back, like you just can read 25 books. I actually read quite a bit just to understand how VCs make decisions. Like, what's the VC economy and equation looking like?
Yeah.
How do they make bets?
So important.
Exactly. Like, I almost needed to know their job as good as they do in order for me to help me do my job in fundraising.
Yes.
Right. So I literally kind of try to understand why is it important for me to even know what the fund size is? Because I've seen this being like, I've been advised, like, you ask these questions, but I was like, how do I use that information then? But then I later learned that, like, most VCs want to return their whole fund with every bet they make. So you need to do the calculation between their fund size, the amount you want to raise, the dilution you're getting, or the share, the ownership they're getting, and then the probability of success here. The combination of those is going to tell them whether this is a good bet or not, right? Over time, I learned like how to tell our story to first simplify a little bit the complex kind of industry we're solving for VCs to understand. And then being able to kind of show with traction how we could reduce the risk for every check size they were kind of willing to write. And look, I would say that the first 1 to 2 years were not super successful in fundraising, and I can explain why. But I think we approached this very, very iteratively, like meaning that we were not hard-headed that we need to raise $5 million before we quit our jobs. No, we actually quitted our jobs with the first $100,000 check. And we're like, we're in this full time, no matter whether anybody else gives us money or not. So the assumption is we're building this with $100,000 in the next 12 months.
Yeah.
And then we hit certain milestones, we're going to get more money. And then over time, we were able to kind of show that traction and convince more VCs. And kind of that iterative process of understanding the market size, the product and market complexity, and the building blocks of kind of de-risking this startup, kind of telling that story was a part of like how to convince investors. Like the market we are serving, I would say that the biggest risk investors took in investing in us wasn't a product risk. Mm-hmm. It was a market risk, right? And then market risk, unfortunately, is less controlled by you as a founder, more controlled by the ecosystem itself, right? So, but you need to show how dynamically you're going to approach that risk and how are you going to execute a roadmap that can address different components of the risk.
Yeah, but I just want to get clarification. You didn't get started on this with 100K. You were already started, but you were more committed once you got that.
Yeah, absolutely. Yeah. So one cheat code for most founders, you never pitch an investor saying like, I have a day job, but I have this idea and I want you to give me your money for me to quit my job. That never happens. So I would rather you pick up your exit date from your current job and like know that that's happening no matter what's happening in the conversations with investors.
Yeah.
We actually, so the way it happened was this. The three of us were like, all right, we're going to each chip in $5,000 in the company. We're going to form a company, and we're going to use that $15,000 to contract a few engineers for a few months to help us build this product. Mm-hmm. And we did that. So let me tell you the story of the starting point here. So when we started the company, when we started the market research part, it was 2019, early kind of pre-March of 2020, right? Most people know that March of 2020 is when COVID hit New York City and put the city on lockdown, and this is where we live in. And the silver lining of that situation was that the problems we were solving kind of emerged to the surface quite a bit. Most of the government and healthcare entities were like trying to figure out if people locked in their homes had prescription refills, they had enough food. Like hospitals were filled up, so you couldn't go to the hospital, but you might still have multi-chronic conditions and you need to go and visit a doctor. So you need to figure out where you're going to go to an appointment, how you're going to get there, because if you're exposed to COVID, you're at risk of losing your life because you have diabetes and cholesterol and so on and so forth. that problem was so hard to solve to the extent that some government entities and healthcare entities started just hiring volunteers to make phone calls to people just to know who needs what. The problem with that was it wasn't scalable. In a city like New York City, you have a few million people to reach to, right? That's when we built, basically me and Naman built the first version of our product, and then we hired an engineering friend to make it a little bit more robust. The product was the simple AI agent. At the time, wasn't an agent. Basically, a AI-based automated communication or engagement solution that would make phone calls, emails, and text messages in two languages, English and Spanish, depending on what the member spoke, and was able to do check-ins and send them communication about the service being delivered to them, et cetera, et cetera. So the member-facing kind of bridge was that. Most people listening to this was like, isn't like member engagement already solved in healthcare? The problem with the existing solutions was, first of all, they had no arm into reaching people through their community. And most people wouldn't pick up a phone call coming from their health plan, unfortunately. The second one was technologically, it was hard to reach those people in their language and in their communication channel of choice. A lot of these were older adults that just had a landline, and you needed automation on the back end, but on the front end, you need very simple user interface, which is typically a kind of conversational solution that can talk to someone that might even have hearing impairment, right? Yeah. So we built that, we shipped that, we started kind of getting some proof of concept. We got a few community-based organizations in New York City. We launched the first one in East Harlem as the first community we launched in, then Bronx and a few others in Brooklyn and Queens. Then City of Yonkers government was like, all right, you guys are doing a good job in New York City. We want to use your product and we're willing to pay for it. And then they bought the product and started using it. Then New York State government was like, all right, and we seen like city area and Westchester area you guys are working, this problem is even bigger in rural areas in Western New York. We want to partner with you. And we partnered with New York State government, Office for the Aging, Department of Health. And this is when we still had a hard time convincing investors. Like this is when I went out and talked to the investors, not with a kind of a sketch of an idea. Mm-hmm. We already built a product. We literally used our own money to build it. And we already had one or two customers willing to pay. For some of them, we just gave it for free because of the dire situation the communities were in. Like we didn't want them to even make a purchasing decision. We wanted to collect data and kind of show some level of product market fit. With that, I went to the investors. So I think I pitched like, I remember exactly, it was like between October and December of 2020, I was pitching a handful of investors every day.
Wow. Yeah.
So I got probably upward of like 100 passes during that time, yeah. Right? And I want to remind everybody, we're talking about 2020, 2021. For folks that are early in the startup kind of landscape, 2021, you could have a dead piece of wood and some investors would throw money at it.
And a lot of money. It was high valuation.
100%. Like still a lot of companies are struggling with the valuations they got in 2021. We couldn't raise $100,000 on like $2 million cap.
Wow.
We couldn't do that. And then we kept pitching investors. I'm like an iterating. Like I basically took a very iterative approach to this. Like every investor meeting, I take notes, go back to my deck and adjust it a little bit, adjust the story a little bit. In certain areas, I had high level of conviction. So I was like, for certain areas, I don't take the feedback. I'm like, this is our conviction. I'm going to just try to find the investor that resonates with it, not adjust my conviction because I want the investor to hear what they love to hear. Fast forward, I pitched Jeff Becker at the time of Forum Ventures, now at Antler. And he was like, they were running an accelerator type of kind of operation. So there's like batches of investments and it's like pre-seed checks. They would cut like $100,000 checks basically. And then for each batch, they had like a certain number of checks they would cut. I think we were probably their last one or probably the one before the last one. Mm-hmm. Pitched Jeff. Jeff coming from the go-to-market background, he's worked in sales before.
Yeah.
He kind of understood the uniqueness of our go-to-market strategy, which is like through community-based organizations. So we're not going after the United Health Groups and Aetnas of the world. We're going after your kind of mom and pop housing operation in the community. And the key problem we faced with investors was like, all right, that annual contract value is like $10,000. You need a hell lot of them for you to build $100 million revenue company. And we tried to explain that's not going to be our core revenue. It's going to be the enterprises. But for us to get the enterprises, we need those community-based organizations as the kind of SMB service providers in the communities. That's your go-to-market risk. They're like, so you're like, I literally remember an investor telling me like, so you're selling sandwich today, and and you want me to invest on a pizza shop you're going to open in a year or two. I was like, that's not how it's going to work out. It's like, I'm selling sandwich today. I'm just selling sandwich to teenagers today. And then like in a year, I want to sell it to family households, basically. But anyway, Jeff was very receptive to the uniqueness of the go-to-market strategy. He did a couple of conversations with me and then my co-founders as well. And I was like, all right, I feel like you guys are going to be at this. It looks to me like the problem you're solving is so personal to you. He convinced his team that this is a bet worth making. He cut the first check, the $100,000, and then he convinced one of Forum's LPs to cut another $100,000 check, but like after like 30 days or 45 days of our progress, basically. And then we're like, all right, we made it. we got money. Again, I want to remind everybody, this is $200,000 during a year that most seed rounds were like in the range of $5 to $10 million, basically.
On a napkin.
Yeah. 100%.
Yeah, that's crazy. Can you tell me a little bit more about what that time period was like for you all? Because you're dealing with people's lives.
Yep.
It's an incredibly stressful time period. I mean, like for anyone who doesn't know this, New York had like trailers of dead bodies next to hospitals. If you had an emergency, you were risking your life going to a hospital.
100%.
And on the other side, everyone was just sitting in their home, stressed out.
Yep.
Yeah.
Yeah. So
you're dealing with people's lives. Like at that point, probably very, very much, I don't know if it was high touch for you or how that was working.
Yeah. So that's the beauty of our go-to-market, in my view. And again, like I'm a very high believer that like I'm a technologist by background, but I feel like the best companies get built by unique go-to-market strategies. That's my thesis. I might be wrong in certain companies, but overall, I think like that's the most deterministic factor for a company. So we partnered with community-based organizations that had a staff to serve people in the communities. Yeah. So this is almost like if you were in the age of Uber, it was beautiful that Uber disrupted the transportation industry by democratizing kind of ride providing side to the general public. Mm-hmm. But just imagine if the first iteration was going after taxi medallions and be like, hey, we have a much better demand generation solution for you. Mm-hmm. Come use this. And if the demand surpasses the supply, we're going to funnel in other types of service providers, other types of basically drivers to supplement that, right? That's why I think kind of the go-to-market strategy was so helpful for us, because we literally had community-based organizations across New York using our product to engage hundreds of thousands of people. Mm-hmm. And when needs were detected, there were boots on the ground that could help these people get some of their needs addressed. I still remember this is like early phases of COVID when most people were not even familiar with the symptoms or didn't know how COVID transmits to others, et cetera.
Yeah, we were still wiping down our groceries.
Yeah, 100%. We had an older adult, I think it was like, she was 85 years old, living alone in Upper East Side, if I'm not mistaken. And she said, I have some symptoms. And by the way, I have, she had a few kind of cardiovascular problems, which was very serious if she had COVID. And she was like, my kids do not live in New York. Like she was talking, just a reminder, she's talking to our AI solution. Mm-hmm. Can you find someone in my community that can help me talk to a doctor, a primary care provider, something.
Yeah.
And then we basically flagged that for an organization in that community. They showed up to her door,
That's amazing.
masked up, etc. Took her. Again, like I don't know if we saved her life or not, but the point here is that technology-enabled component on the community layer made it possible to address some of the needs in the communities. That being said, we didn't even have a product user interface on the enterprise side. It was a piece of code.
Yeah.
So we were high touch, hands on. We're like, for every customer we're dealing with, we're like, what do you need to detect from your members? What do you need to communicate with them? We're going to plug that into our system and we're going to collect the data and show it to you in a dashboard. You don't do anything here, right? So it's almost like, again, just to use an Uber example here, is like almost if in the first version you needed to call somewhere together, right, instead of tapping an app, right? The primary reason that was the case was like we're getting wrapping our hands around like what are some of the core repeatable functionalities that makes a kind of that venture scale company, right?
Yeah.
So that's what we're iterating on.
Yeah, that's amazing. I mean, it just was such a crazy time.
100%. It was very crazy.
And you were in the craziest like sector.
It was so I still remember when the lockdown announcement happened. I think it was like first or second week of March 2020. I still have an email to my co-founders. I was like, guys, this is gonna be scary, but believe it or not, this is our moment to shine. Like we need to gear up. How do we build a solution that actually can meet the moment? And that's why like we had and again, that conviction didn't come overnight. It's like we have done a year of work before that, kind of understanding the market better.
Yeah. So then you're out there pitching people.
Yeah.
Or on Zoom,
Yeah.
pitching people.
Yeah.
You get a lot of no's.
Yeah.
How did you keep your mentality up? How did you keep the team motivated? How did you keep going?
Yeah. So there's a couple of different tactics we used. The first one is basically decoupling fundraising from the company, meaning like we didn't tie the company's journey to fundraising.
Yeah.
Fundraising was this thing on the side that if we were successful in, it would charge our growth, but we needed to have multiple different types of plans. If we have $200,000 or we have $100,000, I still have those Google Sheets. Like there's like 20 tabs with different amounts raised. And then like what can we accomplish with each of those, right?
That's brilliant.
The second one's like I want to admit, like early on, it emotionally got to me. Like I remember nights that I would put myself down with a cry, basically because I got so many. It's just emotionally so draining. Just imagine, like I know people that you have high level of respect for telling you have a very ugly kid every day, like 20 times basically. It will bother you for sure. But I think what made us kind of get through it is really progress. Like progress gave us the confidence that we're seeing something that it's a miss to the investors that are saying no to us that they're not seeing, right? Like I was like, this is something that's going to be so big, they're going to beat themselves up that they said no to us. Not out of arrogance, out of progress, like out of data and evidence that this is working in the market. And then the last thing I would say is really persevere. Like we had this acknowledgement that we're raising in a market that most VCs might not have a lot of kind of personal experience with or a lot of kind of understanding on. If you're building the next social media app, like everybody has probably watched Social Network and kind of has some fantasy of funding a the next breakout social network next, right? But most people do not really know even what like social care means or like what social services mean, et cetera. And then like if they know, they tie to poverty and probably do not think of it as a mechanism to make money, right? Or a business space or opportunity to make money out of, right? So we're like, all right, we understand that. That means that out of every 100 investors we're talking to, probably 10 of them are going to have a level of understanding, 90 of them almost no understanding. Our job is to educate them and make them understand and buy in, but there's only so much we can do, especially again, 2021, everybody's starting companies and they're pitching investors, etc. So they have a lot of fatigue of being pitched by different opportunities and ideas. But then having the persevere to go through those 90 to find a 10, and going through that 10 to find like one that might have a reasonable chance at converting. So I literally had a kind of almost a sales pipeline like chart of the investors I was talking to, and like probability weighted. Like I almost kind of started gathering patterns, like, has this investor ever invested in healthcare? Do they have a kind of a thesis around it? And then, to be very clear, that's not always a plus. It's a factor, it's not a plus, because sometimes investors investing in an industry means they have developed a thesis that might not align with your thesis, right? And you're going to have a very hard time convincing them otherwise. Sometimes the naivete of not investing in the industry might help better. But anyway, that's a factor to consider. There's a bunch of other factors to consider. And through that, we kind of almost created a pipeline that we knew that if you feed in 200 pitches at the top, you probably are going to get like 2, 3 at the bottom that are going to potentially convert to a check. And then the kind of hard problem of finding a lead versus follows, et cetera, all those kind of played into it too. But like running a very mechanistic process was the way we tried to kind of be as much emotionless to it as possible.
Yeah, I think that's really smart because it is difficult. You know, we hear VCs saying we have a thesis, we need to hit, you know, you turn the fund, all these things. It's not personal.
Yep.
But then we also hear VCs saying, oh, we're betting on the founders.
Yeah.
So it's, you know, I know there's nuance in this that we're not covering right now, but it is difficult when you're hearing no over and over again for something that you truly believe in. But what I think is critical is that you clearly had a plan for keeping the lights on.
Yep.
That wasn't depending on funding.
Yeah, so there are two things here. Let me actually comment on betting on the founders, because that kind of catches my attention every time someone talks about it.
Yeah.
There's a blind spot there. So when VCs talk about betting on founders, they're talking about betting founders that match the historical pattern of successful founders, right? The blind spot there is that if you enter a new market, if you enter a new platform shift era, or if you enter a new kind of line of business within an existing market, you need a recognition that those patterns might not be as fundamental as you think they are, right? I think that is super important. That means what it tells me is like maybe a founder that will build the next $100 billion company, but that $100 billion company being in healthcare doesn't match the patterns of Airbnb founders and Uber founders and kind of most recently like OpenAI founders and so on and so forth, or older like Google founders, Microsoft founders, et cetera, right? I personally think most VCs do not recognize that. There's a reason for it, because they don't have a solution for it. It's very hard not to have a pattern because you don't have any historical data about that industry or about that new kind of platform era. I think that's super important to consider, especially for founders. If you're convincing investors to invest in your company, you need to be conscious. Because sometimes you can actually engineer that pattern matching, almost like you could fit into some kind of patterns that the investors would love to hear, right? Some of them are getting a degree at a school that investors will love to have on their kind of scorecard when they're showing to LPs, et cetera. Some of it is really kind of having certain levels of experience, past kind of exits, et cetera, and then certain kind of characteristics behaviorally, right? But then you need to be also conscious that if you're in a new era that those patterns don't work, your job is a little harder. And you need to be able to figure out how do you reverse engineer your way into that. That's why I think like if you're not a Stanford graduate, right? You need to reverse engineer your way into the club, right? Because you don't match the pattern. if you're building for healthcare, which like there's not a ton of historical exits in it, investors do not have a lot of case studies to know like here are the patterns that are the best to bet on in the founders. And most of the pre-seed seed, I would argue to some extent Series A is bet on founders. And I think that's the hard part that we had to figure out. On the second part of your question, we kind of ran the company and we still are doing that, with a very, very lean mindset, right? Almost to a scary level, like meaning that we would basically nickel and dime every investment we're making, every spending we're doing. We wouldn't go to kind of conferences. We wouldn't unless we know there's a number of our customers there that with conversion rate, we can get one of them convinced, so that for the $2,000 for the commute and hotel and all those sort of things we're spending on that conference, we're getting a $10,000 contract out of it in a span of time. Like that literally was the math behind every marketing investment we did. And then we tried to initially build our engineering team offshore. So my two co-founders are Indian. We started building an engineering team in India. We had a very good quality level of engineers kind of brought together there, which kind of helped us manage our costs. All of that with a mindset that we're building a venture scale company, but we want our destiny in our hand. Like we want to be default alive at any moment. Right. So if you kind of unplug that funding, we might not grow as fast as we want, but we still are gonna survive. And that was really the mindset. It's interesting because if you fast forward to today, we have raised our Series A, I think in Q1 this year. I've barely even touched that money yet. Yeah. It's like that's really with the mindset with which we run the company.
Yeah, it's brilliant. I love that you jumped forward because there's a couple questions that I have regarding that. First, you raised, I guess, pre-seed in a frothy time, and it wasn't frothy for you. Then you raised your seed round of $4.2 million in 2023, I think. Yep. And then this year you raised your Series A of 26 million.
26 and a half,
Yeah, 26. So can you, looking at those different fundraising processes, can you tell me like what you remember or what was different about each one?
Yeah, absolutely. So one general pattern, it got easier the more we went ahead, nice. Right? So I think that's not surprising, but it's definitely helpful. I know how much we could put up with the hardship at the beginning, kind of continuing over time, right? For our pre-seed, we actually didn't do it. So we did it with safes, and we didn't do it in one shot, right? So we're like, all right, if we can't convince investors to give us $500,000 or $1 million, let's convince them to give us $100,000 and let's make some progress. And then let's go and raise another $100,000 with that progress at a higher valuation. So we're three co-founders wanted to manage our dilution as well. We couldn't raise $500,000 on $2 million right off the bat, right? And lose, 25% of our company. So our pre-seed, I would argue, was a little kind of with a drip strategy. It was like, get some check, make progress, get the next check based on that, which is actually an advice that Jeff and the foreign team gave us. Like, it's okay. Like, if you can't block it into one round, it's fine. Just do it gradually. But what we did as a result, or one of the kind of silver linings of that initial phase being hard for us, was that we learned that we need to build the company. We need to build our product. We need to create kind of customer traction. We need to show revenue. We need to show kind of product stickiness, retention, et cetera, for us to be able to convince investors. We need to almost make this a slam dunk for investors. Like, it's got to be no question that this is going to become a safe bet for them. If it's not becoming a $50 billion company, it can definitely exit at a level that I'm going to return my fund, right? That's got to be almost like, probabilistically speaking, relative to other bets they make, very, very high probability. And that only show up with progress. So basically what we did was we set with the investor pitches with it, we collected a lot of questions and risks, and we created a kind of a planning document showing what are the risks investors see in our business. And then which of these risks we can address at what cost? Like how much progress do we need to make to show this risk is not relevant or is very minimal, right? And then we basically almost mapped out which risks are we able to execute on with $100,000, with $200,000, et cetera. So we executed those all the way to our seed round. When we did our seed round, this is when we already had a state contract in New York. We had a kind of a couple of contracts in a few different states. We had partnerships with the city of Houston, I think, Dallas at the time. We had a couple of other kind of contracts in a few different states at the government and healthcare level, where I would argue that most companies in that stage probably will go and raise a Series A.
Yeah.
Right? I remember this, that most investors told us, like, if you're at the time, this is again circa 21, 22, most investors are like, if you're at $1 million revenue, you're going to go and raise Series A. Like you've proven the concept, you want to scale up, et cetera, you can go get money. With that, we went and raised our Series seed, basically, right? That's when we did the $4.2 million. Now, the way we got that was this. It's funny because basically Jeff made an introduction to one of the partners, Gaurav, at A4 Capital. I think it was like 2022. They're friends, and told him that there's this company that I've invested on. They've made some progress. You might want to look at them. And Jeff never makes an introduction in a kind of a pushy way. It was like, leave it to the investor, which I almost always questions, like, why don't you give them a stronger push? Like, tell them invest. Don't tell them you might want to look at them. But anyway, Gaurav was like, look, it might not be a good fit for us right now at this stage. And we got a pass even without pitching, right? We executed the next year. We had some kind of more kind of longitudinal checks in. We got Metrodora Ventures, Chelsea Clinton and Caroline Cassie's fund. They invested in us. Overlooked Ventures invested in us during that time. And a few small angels. We actually had the DoorDash co-founder invested in us during that time as well with a $50,000 check. We executed very focused, or like, here are the milestones we need to get to. A year after, Jeff again pinged Gaurav, like, these guys are still looking to raise. You might want to look at them. And that's when Gaurav was like, they're not dead yet. Like, I thought they're going to be dead by now. So he took a call with me. He was like, all right, let's talk. I'm like, I was surprised you guys are still around. I thought like you're going to probably not going to be able to keep the lights on.
Did he literally say that?
Yeah. I mean,
Wow.
yeah, it's like, you probably cannot, like, you're not going to be able to raise and the company will die. His first curiosity was like, how did you keep alive this past year? Like, I want to just understand, like, how did you do that? And then that was kind of the path for me to show him what we have been able to execute with so little capital. And then I was like, all right, this now makes sense why Jeff was asking me to talk to you guys. And then after a few back and forth, Gaurav took a bet on us. And then because of him, we got Crossbeam Venture also interested, which I really love as a fund. And they, together with a few other kind of investors, basically formed our $4.2 million seed round.
When did that close?
It was summer of 23.
So, I mean, just again, to like timestamp this again, like in May of 2022, we had a massive constriction in the market of funding as well.
Yeah.
So you went through a frothy period, and then you raised during kind of a tough period.
Yeah.
You know, like Silicon Valley Bank, I think.
Yeah, that's exactly when
like
that
all
happened.
this stuff was happening, and the word on the street was like, no one's writing deals.
Yeah.
But you were able to raise them, which is amazing.
Yeah, so it's funny you're saying that, because I feel like we are building a business that basically is, I don't know if you've ever read Sam Walton's book about how he built Walmart, right? I can bet you I can bet you if Sam Walton was building Walmart today, no VC would take a bet on him,
Yeah.
right?
Yeah.
Yet he built one of the largest companies in the world. I think by revenue, they're the largest company in the world, right? Why does that kind of matter to me? It's like you need to build a company that, first of all, it can endure tough times.
Mm-hmm.
Second, when tough times happen, people start doing math. They don't make decisions by emotions anymore. No longer if you're a kind of Stanford graduate or if you're ex-Googler or et cetera, matters. Can you generate cash as a company or not? That matters. And we were able to show that.
Yeah.
That's why that was our time to shine. As like, while everybody was like being more disciplined about investing, everybody had frameworks of decision making that matched what we could offer them a lot better than the year before, where everybody was like, all right, are you building the next crypto kind of whatever, or blockchain, this and that? We're like, no, we're building we're using AI. And it's funny because even at the time, AI wasn't that hot.
Yeah.
This is like, again, pre-ChatGPT, AI wasn't hot. If you guys don't remember, you were losing your money on crypto at the time, basically. Crypto was the one that was so hot, and we had nothing to do with it. And we were actually a little boring for folks that were like so excited about crypto. So as a result, it was a hard time to convince them. But yeah.
That's amazing. So let's jump to your $26 million Series A.
For sure.
Tell me a little bit about how that process went.
Yeah, so one of the things I learned during fundraising was that you need to build relationships, especially if you're building it in a space that you need to educate the investor on. You need to build that relationship for a longer run. You're going to have a much harder time helping that partner or principal or associate in a firm going and convincing their IC overnight, versus if that person is giving them update about this potential deal every quarter or every other month, that, hey, these guys are growing really fast. We might as well kind of think about them or talk about them more seriously, et cetera. So kind of going back to our mechanistic execution process, like, all right, I'm going to build a pipeline of relationships. This time, not just pitching them, but building a relationship. And then I'm going to take meetings every quarter or every other quarter and give them update on what we've been able to achieve. Inside Partners was one of them. They reached out to us. I think it was like after our seed round, talking a little bit. They reached out to us, just talking a little bit about our business. They linked. It's funny because they have they've written a blog about aging space and then like a little broader social care space. That in one of their reach outs to me, they sent that link along. And then I read that and I was like, all right, these guys are worth their grain of salt. I might as well like talk to them. This is not, they're not blowing smokes. They're actually spending the time to learn the ecosystem. So I'm going to have a little easier time educating them on what we're building and why it matters. So I took a meeting and then I would basically do updates every quarter. And they were not the only fund we did this. It was like, I think around 10, 15 of them. We did this actually with some of the major Silicon Valley firms as well, like General Catalyst, Sequoia, A16Z, et cetera. I still have those relationships as well. And then when it was time for us to raise our Series A, it made it a no-brainer that I'll go first to the investors I've built a relationship with, because they've already done some of their diligence on us, and it might be much easier for us to get to a decision with them. And that's what I did. I want to mention this, and some of our existing investors are seeing us here probably, that when I said that I want to go and raise a kind of a $20 to $30 million Series A, they're like, you're out of your mind. We're gonna support you, but you're out of your mind. And I was like, all right, that's okay. Like, I get you. I understand why you might question it, but I feel like we have the credibility because of our progress to go and raise a relatively larger Series A. And look, it has taken us somewhat so long to get here to that we have been into a kind of a minor down and up cycle, understanding that I want to have enough capital in the bank to be able to execute.
Yeah.
And I want to almost raise a Series A that if I never raise again, I have a sustainable business. And then I started talking to those investors. We had made quite a bit of progress at the time. Some of the numbers that you've probably seen, like for instance, we were serving 1 million people at the time when we were doing our Series A. Like again, put aside your kind of top 10 companies of technology history like Facebook, Google, et cetera. There's not a lot of companies that grow to 1 million people in a SaaS space this quickly. So that was very impressive for investors. We went through some kind of diligence process, and fortunately, they Insight ended up taking a bet on us. It's funny because when I started the process, I put, I think, 2 or 3 funds at the top of my list that I was like, I want to go partner with them.
Yeah.
Insight was one of them, and I was so excited that we got an opportunity to work with them.
And who's the partner that you work with at Insight?
It's Scott Barkley. So it's Scott actually oversees a lot of I think all of their healthcare investments, if I'm not mistaken. So basically the way Insight invests is that during the process, you need one of the investment committee members, which is much limited than their partners, to be sponsoring the deal. The person that sponsored our deal was Jeff Horing, which is Insight CEO. So when we kicked off the process, we took a few of the steps in the diligence and pitching and providing kind of data room and follow-ups and all those sort of things. The Insight team was like, okay, we're now ready to invite you to our office to meet Jeff Horing. And it was one of the most kind of scary kind of moments for me. Jeff is very impressive. I really love him. Like I know folks have seen his recent interview on Invest Like the Best. If you haven't, I'm just putting a plug in for that as well. He's a very much of a first principle thinker. It's almost like a Warren Buffett in the VC space, if you will, like less of a hype person, more of a like very principled kind of investment person. And I spent an hour and a half in his office, and it's like by Bryant Park, kind of facing, I think, 6th Avenue. Is like very intimidating as well. Just watching from there, the streets of New York City. We had very interesting discussion, and he impressed me how much he had appetite for learning. The industry, the business, the intricacies of it, the exact elements of efficiency gains, the dollars that were generated by those, the potential opportunity to scale that up, et cetera. And fast forward, when it came to the IC meeting, he was the strong pushing kind of factor to make the deal happen, which I remember one of my kind of what's it called? The stars on my scorecard of career so far is like the Insight team sent me an email and they're like, "This is a very impressive CEO. We should take a bet on him." And I was so
Nice.
it was given that I was so scared to go in. I think that was really really good outcome for me.
I've heard exceptional things about Insight partners as investors.
Yeah.
What do they bring to the table for you beyond money?
Yeah, so that was one of my main factors and our team's main factors in deciding who we want to partner with. Capital was obviously one of those factors, but it was like what besides that they can do. I think there's a few different elements that Insight brings to the table that is super helpful to us. One of them is they have a pretty impressive portfolio of companies. So they have a really unique knowledge base of how to operate, from how to acquire talent, how to manage talent, how to manage finances, how to think about kind of M&As, exit strategies, fundraising, et cetera. So that knowledge base is super helpful. That knowledge base is converted within Insight into what they call centers of excellence, which is basically industry experts that use those knowledge bases to help their portfolio companies execute, right?
Yeah.
So they literally have team members that when we were hiring VP of sales, VP of engineering, et cetera, we would put them in front of them to interview the like last steps for us. when we're designing our comp structure, when we're planning the kind of our growth, when we're thinking about how to manage our finances. These are folks that have a lot of deep expertise in operating space, but then folks that have expertise in our industry. Like I got to talk to CEOs and presidents of Blue Cross Blue Shield and United Health Group and so on and so forth, because they're on Insight's kind of payroll that can help us, not existing ones, like past ones, that we were able to get a lot of kind of strategic advice on. I think those are the core elements. Obviously, they have a lot of reputation and respect as well, which means that you can open a lot more doors with that as well.
Which is critical. But I know someone who has Insight on their cap table, and I was like, oh, so how often do you talk to them? He's like, I talk to them once a week. And he brought that exactly up. He said, they have the capacity to help me with some of the challenges we have beyond my team.
Yep. Yeah, 100%.
Yeah, it's
100%. I think I've talked to Insight team in the past 4 weeks, probably 6 or 7 times, which averages out to more than once a week. I want to mention this, I think, because like founders sometimes kind of, when you talk about frequency of engagement with investors, they get a little bit kind of anxious. Is like, are the investors getting in the way of you operating or not? I want to clarify, like, that's not the nature of relationship here, right? It's basically them answering our questions, not them telling us what to do.
Yeah, that's what shocked me so much when I was talking to this CEO. It was like, oh, that sounds like a pain in the butt. And he's like, oh, no, it's amazing.
It's amazing.
It's fantastic.
It's so good. Yeah, absolutely. Look, if I go back and I look at my top 3 choices of funds, knowing what I know right now, and then look, frankly, I don't know as much about the other 2 funds as I do about Insight, but I'm so happy about the decision we've made. There's like a few different inflection points in the past 2 to 3 quarters we've started working with that they have been so influential on the direction we took with the right decisions because of the resources and the input they gave us.
Yeah, that's amazing. Good plug for Insight. Anyway, but real plug. Looking back at where you've been, like back to before you even got Jeff Becker, to write that check, if you knew that you would be here in 2025, having closed, around a 26.5 million, but it would take that long, do you think you would have done it?
Yeah, that's a great question. And by the way, this again, for the founder audience, questioning your biggest life decision or one of your biggest life decisions, which is kind of starting a company, is okay. Like, that's psychologically okay. It's healthy. Do it. It's fine. Like, do not be scared of questioning that and drilling down into the fors and against kind of feelings you have for it. This is a little bit of a founder therapy here, because like a lot of times people feel like a little hesitant of even questioning whether they took the right decision to jump in, or and that results in some unhealthy kind of situations or behaviors. Now, for me personally, there are 2 elements around this decision that I think I've learned about over the course of past few years. The first one is, we started this company because the problem we're solving was worth solving and important solving for us as founders. This is very, very important. The most important, in my view, success kind of leading indicator for a founder is whether they can take pain and can persevere through pain or not, right? This is important because if you are solving a problem that is important to you, that is personal to you, then you're gonna persevere through it. I actually think that because I've look, like many other founders, I've read a bunch of Paul Graham kind of essays and a couple of other folks, investors and operators. A lot of times investors say like founders should start companies about problems they themselves need to be solved. I think they missed to mention that that's not because you would be in a better position to judge solutions that would work best. It's because it's so personal to you. You want to find a way to solve that problem, right? because you're going to be knocked down many, many times along the way. And you just need some fire in you to get you stand up and go, right? And I think that's really primarily the problem you're solving. I can bet you that if I was kind of building a company that wasn't as personal to me, I would have probably quit it much sooner.
Yeah.
The second element around this is how much, as a founder, when you start the journey, how much pain do you think you're going to face, right? It's like there's this view from outside that, oh, it is so great to start a company, to be your own boss, and like these are fantasies. You're gonna start a office, and you're gonna have ping pong tables in it, and you're gonna be able to hire very cool engineers and salespeople, etc. You're gonna be very powerful. You're gonna go talk to media, all those sort of things. While those might be the case too for some companies, I've seen probably more than 1,000 companies over the course of past kind of 5 years since I started this journey. 95+% of the time, that's not the case. It's so messy, it's so painful, it's so challenging. When I look back, I grossly underestimated how much pain it takes to build a company, how much challenge I'm going to face, right? I think if I go back, I will recalibrate that understanding. But because the problem matters to me so much, I still am going to go into this journey, and I'm still going to go build it. I probably will, take a more frequent mental health appointment and therapy appointment and so on and so forth. I probably kind of stick with my workout regimen a little bit more diligently, because all of those help with my physical and mental health. But I wouldn't underestimate how hard it is.
Yeah, you're rolling right into my next question, which is, how do you stay mentally, physically, and emotionally healthy during this? I mean, it's more than a marathon. It's an ultra.
100%.
Yeah.
It is. It is, especially if you're building in an industry that is relatively hard to solve problems in. You need to be ready for a kind of a decade journey, right? A lot of people fantasize that they're going to build the next Instagram and exit at $1 billion, with 10 employees, and they're going to become wealthy and so on and so forth. Again, I think that in the era we are, with AI enabling us to be solo founders or start companies with much less headcounts, I do not think that you should underestimate how long it's going to take you to build a company that is going to be really kind of a venture scale company or a big company. So for that, you need to have a plan. You need to have a plan to the details of when do you want to buy a house? When do you want to have a baby? When do you, if you're married and you want to have babies, when do you want to basically have some leeway to travel or to be able to kind of do things with your family, et cetera? You need to take into account your parents and so on and so forth. If you're a caregiver, or if they're a little older and you want to spend more time with them, et cetera, it's going to be important, because you're going to be making those decisions whether you like or not. You might as well be prepared for it. The second thing is really kind of, for me, it's actually my team, our employees actually hate this because they think this is so boring. But for me, the way to keep sane is running. I actually run around 8 miles every day. At the minimum, I'd say 5 days a week, most of the weeks, 7 days of the week. I don't necessarily recommend to everybody if this is not your thing, but you need to have something that's your thing.
Yeah.
And I do that. I spend an hour and a half with workout and warm up, cool down, taking shower, etc. Typically listen to music, podcasts, and late night shows during that time. Yeah. And that's really kind of my reset. And it matters. When I was doing fundraising, I wouldn't miss a day of doing this, because I knew what's coming up, and I knew how much kind of chemically my body is going to be in the wrong place if I'm not doing it.
Yeah, that's so important. And I think also finding what works for you is really
100%.
important. When I was very stressed out, I had to stop running.
Yeah.
Because all I would do is think about, the things that were stressing me out and not in a positive way.
Yep.
So I switched to something like CrossFit or CrossFit adjacent, where when I was doing burpees, I couldn't think about work.
100%.
But not to plug any kind of workout, but just figuring out what works for you
Yep.
to either disconnect or provide you with what you need to reset.
100%. I think you need to figure out what works for you. Also want to mention that like what works for you is a function of you as a person, your personality, but also probably your family. Like not a lot of people have the luxury of spending an hour and a half in the gym every day, right? Because they need to wake up in the morning and take care of their newborns and baby, et cetera, et cetera. So the point is like what service you can do to yourself is to figure out what would work for you and be very religious about doing it. It's going to compound very heavily for you over time.
Yeah, because we hear some people saying meditation is key.
100%.
For me, like physical exercise is really important in terms of keeping my mood stable.
Yep.
And making me a nicer person generally.
100%. Yeah, absolutely.
This is great. So what's next for you? You've just raised, well, not just, but you still have the money in the bank because you haven't touched it basically.
Yeah.
So what is that going to open up for you?
So we try to kind of have very, very clear and visual goals for our team to have transparency and execution. So for us, basically, one of the most elements we have is really how many people are we serving, because the value we generate for our customers is really a function of how many people we are connecting to resources and services. And it's like similar to DAOs and MAOs and those types of metrics. For us, we're trying to get ourselves to 10 million people. We think that if we can get to 10 million people, first of all, the kind of critical mass-wise in the states where we have priority in, we're going to hit certain levels of network effect between the consumers and networks of service providers, that the customer acquisition cost and the sustainability of that revenue over time is going to be orders of magnitude more efficient. So we're executing our way into that. We're at around 6 million people right now, so we're around like 60% there. We're hoping 2026 is when we kind of hit that 10 million user milestone, probably the first half of 2026. The second kind of component for us is really getting to around like $40 to $50 million in revenue. And that's kind of somewhat correlated to the number of users that we're talking about. So that hopefully will happen in 2026. Now, that being said, part of what we're trying to do is like do a little bit of a longer term investment. Like so much of the mindset after you do fundraising goes into, by founders, executives, team members, goes into, all right, we brought in an investor, let's impress them because we need them for the next round. And then like you're in this treadmill of just impressing investors with metrics and growth and so on and so forth. Part of what we're trying to do is really to build a healthy, sustainable business. I don't think this is news to anybody. I think we're in some sort of a hype cycle right now, right? So us going through 2021, 2022, 2023, and we know that there's going to be a 26, 27 maximum where things are going to look different, contract. It's capital is going to dry out, et cetera. So we're executing accordingly. We're basically positioning ourselves to look at any further capital raise opportunistically in the next year or so, depending on how market looks and how much we can kind of attract, but also operationally being very kind of unit economics obsessed and understanding how, like our cash flow, understanding our customer acquisition costs, understanding how long does it take to pay back that customer acquisition cost and become cash flow positive for every user we're adding. And as a result, to make a machine here that can generate cash in the next 1 to 2 years. And then hopefully from there, any type of kind of capital raise or allocation we're going to have is more strategic, whether it's like acquiring other companies, especially in the space where there's a lot of fragmentation. We want to be a roll-up vehicle. We want to aggregate and bring different kind of verticals of stakeholders under our platform's umbrella because we automate that last mile delivery of care. We're almost that kind of DoorDash for social care. Now you could plug in a chain of restaurant into it, right? You could plug in a payment application on the top of it. There's multiple different types of ideas and strategies that capital could help us later on that would significantly increase our revenue growth immediately because we have the channel and connection to that population. But we're very, very loyal to our go-to-market strategy. So we're still going that, what we call it, bottom-up then top-down. Every new zip code we go into, the first thing we go after is the service providers or community-based organizations. We get them on our platform. And then after we do that, we go top-down, figure out who are the health plans, health systems that actually care about these population that are in those communities, and then sell into them, right? Because we already have their population, we already can address their need, we have the data about their needs. If you remember at the beginning of the conversation, data is a key asset to make every dollar generating some sort of ROI for those stakeholders.
Nice. So you've got this large company.
Yep.
You're the CEO. You're in charge of making sure that it's profitable and making a return for your investors. How do you stay focused on your mission and clear on doing good while you're also making sure you get a profit? Like
Yep.
you're probably you had to choose the right investor, so that's good. That's a big part of this. But how do you protect against kind of enshittification? Like, we started out doing one thing and all of a sudden there's all these resounding negative effects. How do
Yep.
you protect against that?
Yeah, that's a really, really good question. I think there is a kind of philosophical way of doing this, in my view, is like what I call productizing doing good. Meaning that if you want, in my view, if you want to align shareholder value with customer value, you need to productize doing good. And the question is, can you achieve the art of doing that with technology in the ecosystem you're playing in, where you're not really generating a lot of value for the people, for instance, purchasing goods on your platform, but then forgetting about the sellers or forgetting about operators in your fulfillment centers, et cetera, where like they might be under a lot of pressure, right? And then like, I think that's really kind of where we are both very conscious, but also lucky. This is one of those kind of spaces within healthcare that there is very, very close incentive alignment in between different stakeholders. So let me explain this for people that might not be aware. In the space what's called fee-for-service healthcare, the healthcare provider, hospital, or clinic you go to is incentivized to provide you as many services as possible. They're even incentivized to keep you hospitalized or give you very complex kind of treatments, because the more of that they do, the more they can charge the health plan or healthcare insurer to generate revenue. The healthcare insurer wants minimum number of those to happen because they're on the hook to pay, right? You as the consumer want your sickness to be treated. You don't want maximum or minimum number. You want the right amount, right? So here you have very clear misalignment between three stakeholders in the same value chain. In the social care or health-related social needs, I would say we're lucky, maybe by design because we picked up this, but also because of how the ecosystem in the healthcare space looks like, that there is incentive alignment, meaning that the person that needs a meal delivered to them after they got discharged from hospital wants a meal to show up on their table because they cannot cook, right? The hospital wants to minimize rehospitalization because they get penalized for it, right? And the healthcare insurer wants that patient to stay out of hospital and not face more complexities, right? Now you have three stakeholders, all of them want the same thing to happen. If you have technology making that engine work, you're striking gold there because you have three stakeholders of a triangle that want this engine to turn. You just need to have the right engine to turn, right? And that's where I think we keep kind of that alignment, meaning that we do good for the patient or for the community member. We do good for the provider And we do good for the payer. And through that, we do good for our shareholders because we can generate more value and as a result, capture that value by making that cycle turning much more efficiently and more be more scalable, basically.
As you're saying that, I can already see the slide. Like, do you have a
Yeah.
slide like that?
Yes, we do.
So
Yes.
that's beautiful.
Yes,
Yeah,
absolutely.
it's wonderful to have aligned incentives that support doing good
Yeah, 100%,
and
100%.
improving patient outcomes. That's amazing.
Yeah, I would say that again, like going back, why this problem matters, or like why it was so personal to us to make this work
Yeah.
was exactly because I know my loved one that was facing cancer wanted that right.
Yeah.
I know their hospital wanted to give her that right. I know her healthcare insurance wanted to give her that right. The system was so inefficient that she wouldn't get that right.
Right.
Right. So if you could do good to all the three stakeholders by building a solution for that.
That's amazing.
Yep.
So good. Any advice for founders who are in the early dark stages, like take you back to 2021?
Yeah, so I would say that just taking back to 2021, I think it's interesting because there's a lot of similarities between 21 and 25.
Yeah.
A few pieces of advice here, and this is based on kind of scar tissues and learning experience here. The first one is that you see a lot of fundraising announcements. Do not let that be a pressure on you. Do not get distracted because so many companies are raising and you cannot raise or you're facing difficulties raising. What matters is, can you build a kind of fundamentally sound business, right? And you have a vision on how to execute and scale that. That's really the most important thing. The next most important thing for you is really to figure out how to break it down into pieces that in a sustainable way you can pursue that, right? This is super important because I know founders feel even shame when people are raising $50 million seed rounds and they're like, I'm asking for $2 million and nobody's giving me that money, right? It's okay. Like there's a survival bias here. You're just hearing the stuff that are shiny and interesting and are raising from the investors that have a lot of marketing arms and so on and so forth. That is okay. Keep the focus and heads down on building the business because if it's not in this round, you're going to have the next one or the next one where you're going to have your kind of moment of kind of showing up to that world that you might feel really kind of excited about but not being able to achieve it today. The second thing is really founders need to, in my view, be very, very paranoid with capital and execution. Much more than the average kind of startup looks today, right? That almost correlates with the kind of capital markets. Obviously, when things are frothy, you tend to get more money injected into companies, and then as a result, the discipline goes away. But I think, I'm not saying this because you need to manage your capital. I'm saying this because your success depends on focus. And I think the last thing you need is really the distraction of having way too many employees, spending time on way too many ideas, all of them half-baked, and not having a kind of longer-term sustainable execution plan around it. If I go back in my journey, I would be almost maniacally comfortable and focused on one little thing I can do for my customers, that I can do it much better than everybody else, than wanting to build a platform. The feedback I got at the time from investors was like, you're building a feature, not a platform.
Yeah.
While I respect that, I warn founders that will make you optimize for way too many things early on, and you're not going to have a very strong and a sticky edge in your market. Do one little thing, like one thing that you can do for your customers, like 100x better than everybody else. And that could be very, very, very small. That's okay. It can be even a Google Sheet plugin or function or whatever. But you can do it much better than everybody else. Because if you can do that, the distribution that gets you will help you build a platform.
Yeah.
But if you try so hard to build a platform, you're gonna almost certainly your company is gonna almost certainly die because you're not gonna have a scalable enough edge in the market that's gonna get you enough information in the kind of this iterative process of building your product that will get you product market fit and some sort of scalability over time in the company.
Cool. We're almost done. Any hot takes on fundraising?
So the hot take might be for me that I mean this might kind of annoy my existing investors a little bit, but I think we need more founders that are very opinionated and less malleable to the investors' feedback because they want to fundraise. It's like almost, I feel like investors in the top of the value chain of where dollars gets injected in the startup ecosystem determine what companies are going to be built versus the market at the bottom of it. And then the founders that are building for it determine what companies need to be built, which I think is part of why the hit rate in the VC market and in the VC kind of business model is so low. In my view, you get one shot at this or a few shots in your whole career to launch these types of companies. Do what you think is gonna move the market towards a more efficient, more accessible ecosystem, whatever market you're playing in, and let capital follow that. Do not follow capital. And that's a danger that I think is even orders of magnitude more dangerous in hype markets.
Yeah. Amazing. I really appreciate you coming on and
For sure.
going in depth about all of this.
Absolutely.
I was fascinated about your story when Jeff Becker mentioned it first. And you've been such a great guest giving us insight into this whole journey.
I appreciate it. Thank you so much.
The reason we do this is to really help founders who are, earlier stage understand what it takes.
100%. I'm just passing along, basically. I've learned from others along the way, as you've heard along the story, and I'm so excited that I get a chance to pass this along. And always encourage founders take everything I tell you or anybody tells you with a grain of salt, because you're charting a path that nobody has ever gone through. And as a result of that, there are some fundamental kind of advices that might help you, but most of them need to be adjusted to where you're going. So take it with that lens. But I appreciate you having me here. It was a very exciting discussion for me. I mean, I'm passionate about what we're doing, as you can guess from the conversation, and I always love telling the story.
Cool. And I'm just happy to be here and listening to it.
Absolutely. I appreciate it.
I'm Helena Fogarty, and this was Inside the Round.